Welcome to the XY Advisor Podcast, a global community of financial advisors sharing and learning with one another to drive the positive evolution of financial advice. To get involved, go to xyadvisor.com or simply download the XY Advisor app. This series is brought to you by PIMCO, one of the world's leading fixed income managers. For 50 years, PIMCO has been dedicated to helping millions of investors pursue their objectives regardless of shifting market conditions. At PIMCO, ESG investing is an essential part of their commitment to delivering on their clients' objectives, while at the same time supporting long-term sustainable economic growth globally. Hello and welcome back to the XY Advisor Podcast. I'm Fraser Jack, and today we are part 3 of a 5-part series on ESG investing. In particular, today we're really deep diving into some of the social change, the impact style of investing that's available both to you and your clients, things that you can have conversations about. And we've got some really interesting conversations coming up around that side of it, and some great tips that you can then take forth to have conversations with your clients about. Welcome back, Nathan Fradley.
Thank you.
Thank you for coming along and being part of this series. Now, in this particular episode, we are talking about impact investing, more specifically. What does that mean to you?
I think there's a variety of approaches in this particular space. So when I talk to my clients, I talk a little bit about the individual beneficiary and the greater beneficiary. Now, depending on the nuance of the conversation of the client, would depend on the language I use, because that can be quite a technical term. But when we look at any investment, and we link it back to a goal, an outcome, retirement, saving for kids' education, that's the individual beneficiary. That's their benefit from the investment. The greater beneficiary is something broader than themselves. It's the societal benefit. So people who tend to donate to charities more have a better bias towards this already. But I think talking about that and saying, I mean, the question of if you could get the same return and have a greater impact on the planet, would you? I don't think anyone ever says no. But the question becomes, if you had a lesser return or paid a higher fee to get a greater impact. And that's where the impact comes in as a range between implied impact, which is by not investing in this or by investing in companies better at that, versus investing in an index or a standard product. You've improved things this much. You've invested more into companies doing greater things. You've reduced your carbon emissions and carbon footprint, and that is an impact in itself. You know, within the Ethos software, we measure that in terms of tangible things like fish saved and cars taken off the road. And so that is a tangible impact. Just shifting from a standard index product to an index product that excludes fossil fuels will give you a sense of impact. And it's something that a client, at the end of the day, when it comes to ethical investing, that's what they care most about. Creating the tangibility around that impact is the same as creating the tangibility around the outcome of their goal. You will get to retirement, or you will get to retirement and substantially reduce your carbon emissions by this much, the equivalent of taking this many cars off the road. Oh, well, that's fantastic. You've got to make it tangible, because it's just saying this is more ethical doesn't help anyone. And then from there, the next tier up is the kind of funds that invest directly into solutions, which is interesting because a lot of these tend to have companies that are higher in emissions and higher in these sorts of things, because they might invest with fossil fuel companies that are transitioning into renewable. So they have the old assets, but they are moving, or they are old mining companies that are transitioning. But whenever people think impact and they think greater beneficiary and they think focusing on solutions, they think environment straight away. They go straight to climate change. They picture giant wind farms. A lot of impact portfolios have very small energy generation components, and they focus on, something as simple as gender inclusiveness, as opposed to poorer contracts within hiring practices, or gender identity as opposed to gender inclusiveness, sort of taking a step further. That's a social issue. That within a board, within a hiring practice, can create huge impact. So I think, there's things like safety and, I suppose those kind of areas, things like, Pengana Web has that kind of approach where they focus on the broad range of those things. Then you've got, I suppose, another tier above that where there's funds, in particular, we're starting to see this in the green bond market, where the bond or the loan explicitly directs money to a cause. So there's one bond fund at the moment that has a green bond in Melbourne, or lends money to a Melbourne homeless facility for women between 55 and 65, which is the fastest growing homeless demographic in Australia, due to a range of social factors. And by giving them a place that they can be safe, that they can feel included, that they can get back on their feet, that they can have social interaction, that's amazing. It's a huge impact, and also extremely important to, particularly my demographic, who are in that age bracket. So that could be me. So there's a kind of a more direct one. And then you're kind of moving more up into philanthropic stuff, where some of the investments out there, some of the agricultural stuff, or some of the good credit funds may have a unashamedly less performance, but a greater impact. And I think that is kind of that spectrum between implied impact and direct impact, and then willing to take a hit on performance. I think at the top end of that impact scale, you tend to lose a bit of your own money, but you get a greater sense of social benefit. And I think clients who are comfortable in their retirement, who aren't worried about not having enough money, they have a little bit extra, or they've got enough to wind back their risk profiles, might choose a more philanthropic impact approach, because there's more to wealth than just money. And I think people really feel alignment to that.
Oh, well, absolutely. Well put. So, and great questioning too, with regards to if you could keep the same, have the same returns, spend the same and still have impact, would you? Of course. But then what are you prepared to give up? How much more are you prepared to pay, or how much less are you prepared to give? When you ask those questions of people, what do they say?
A lot of the time, I don't want to lose performance. Like most of the time. The same performance, absolutely. Higher fee, absolutely. But I don't want to lose performance, which is really funny because they're willing to pay a higher fee, which would detract from performance, but they don't want to lose performance. Or detract from net performance. So I think that's an interesting insight into the mind of an everyday investor. But we do get situations where some of my wealthier clients are happy to, providing their goals are being met. We've got our retirement locked down. We're happy to take a lesser outcome. And then, I've worked with some advisors and done some coaching with some advisors that are in the high net worth space, and the clients have substantial amounts of money that they really want to see change, and they're willing to take larger hits on their performance. It's like cash plus kind of mindsets, because to them, they're responsible, they're custodials they've got a custodianship to the planet, or to a particular group of people they feel an affinity towards, and they want to see outcomes. So that's sort of another level again that I think we're going to see the rise of the everyday philanthropic action in a lot more in that high net worth space.
Yeah, this almost plays into a conversation that you could have to them around leadership or status, even in their community.
I think wealth used to be defined as, it's like the transition of a modern society. It used to be defined as nice cars and fancy things, but I think it's transitioning into electric vehicles, organic grass-fed corn. Things like where the sustainability becomes the competitiveness of a sign of wealth. I'm doing more for the planet. I donate to here. I'm helping out here. I think we're going to see some of that. I think that's the natural transition away from materialism, particularly with higher educated people of all political affiliations. I think the people who tend to have a higher IQ will see that as either a good outcome for themselves or a good status symbol for themselves, depending on their motives. But EQ, those people have always been interested in this kind of thing.
Wonderful. Thanks, Nathan, for chatting to us about impact. We look forward to catching you in the next episode when we touch on climate change. Thank you for joining us again, Karen.
Good morning. Lovely to be here.
Wonderful to have you. Now, we're talking about social change and impact and different opportunities for impact investing and conversations to have with your client. What are you saying to your clients about the space, and what conversations are you having with them?
I think clients really understand impact investing to be your cake and eat it too, is the way I would describe it. So it's having, all the beautiful returns we would expect. For the clients that we deal with anyway, look, they really are looking for market returns or better. And then that additionality of having positive and measurably articulated change through what they're invested in. So an example of that would be, and a lot of the funds are really quite good at articulating their impact at the moment, but the equities funds in particular. But certainly we're also seeing that the bond funds that are investing in the green and the social bonds, or even the sustainable bonds, which is sort of that combination of a project that might have green and social benefits, are really good at articulating exactly how the money your clients have invested has actually been put to real world outcomes. An example of that I was going to raise is that one of the global bond funds we use, 94% of their bonds are in impact bonds. So they're focused on really, and this is things, you can share with your clients, which clients love to read about. We put this in our recent newsletter to clients, and we explained that thematically, the top 3 sectors in terms of environmental focus for this fund were infrastructure, energy, and water-related outcomes. And in fact, they were able to, get an investment in the African Development Bank, fight COVID-19 bond. And what that bond has done, it was issued by the World Development Bank. They've actually used that money to basically support companies that are manufacturing essential supplies, including reducing your test result timeframes from 36 hours to a week. So protecting basically livelihoods and 6,000 businesses. And all of that with a really strong credit rating. So I think clients are really interested in how they can be a part of a solution like that and still receive a commensurate return.
Yeah, I love the phrase "have your cake and eat it too." It certainly sums it up for clients when you mention that, and then you can jump down obviously into the specifics of it.
Mm-hmm.
Is it very hard to find these things? You mentioned that there's some funds have high levels of it, but how do you find them and how do you go about researching them?
Yeah, certainly. So there are, I think that the bond funds that are available in the country for the most part are actually not as greenwashed as the equities, perhaps. So I think you'll have some success there if you do your due diligence and have a look at the underlying holdings. What you're really looking for there is good quality issuers that have obviously got that have got certification on that they are green bonds, they are social bonds, and they're disclosing to you obviously how the funds are being put to use. There's also domestically, obviously at home here, we also have some green and sustainability bonds that have been issued to market. So you can either purchase those directly through a fixed income broker for clients, or which we were doing many years ago before these sort of bond funds were issued. But an easier way might be just to have a look at some of the bond funds themselves. And within those, and there's like a handful of them domestically, but you'll find that, clients are invested in some really interesting social and sustainable bonds with names that they're familiar with. And I think that's what makes clients, it makes it relatable for them. So if they know, for example, the Queensland Treasury has issued a green bond that went to finance, for example, this is in my home state, the Gold Coast Light Rail Stage 2 and also a solar farm at the Sunshine Coast and Brisbane Bikeways extensions. That's something that they can understand. So there's many examples of that where you can sort of pull out examples of bonds within these portfolios that your clients are invested in.
Yeah, incredible. And again, goes back to those values of understanding and knowing why they're invested in something. When it comes to the conversations you're having with your clients, are they more towards this? Is it something that you're towards? Because it's sort of, to me, it's not something that you're saying, or you want to try and stay away from something, or it could be with small communities and human rights. But it feels like it's a more of a feel-good type of an environment where you're promoting it, or you're not promoting it, but you're talking about it in a positive way.
I think you could just raise it from the point that, did you know that the bond market is, X times as big as the equities market, and the fastest growing issuance on those markets at the moment is green and social bonds. And the reason is because, corporates and local governments and state governments realize that they need to be part of basically funding the transition to low carbon. So we're relying on, external parties, that's your capital, to basically deliver the technologies and solutions to get us to where we need to be. So this now exists and you can invest in this.
Yep.
So clients would just not be aware. And when they know that their own home state, and this is across all states, have issued green bonds, I think that gives them comfort in understanding and why have they issued green bonds? Because they realize that there are projects that the state needs to deliver that they can't fund themselves. They can issue it at a fair price and receive external investment to fund that infrastructure project.
Yeah, wonderful. Karen, thanks so much for coming on and chatting to us in this episode. We look forward to catching you very soon in the next one.
Thanks, Fraser.
David Graham, welcome back to the conversation.
Thank you once again.
We are talking about the impact investing in social change, something that's, I feel like it's a fairly new area of the ESG. The S in ESG is sort of more of a newer area. Governance has always been there for quite some time. We're used to this now. And the environment's certainly been a topic of conversation, but the social sort of missed out a little bit and sort of is lagging behind a little bit.
Yeah, it certainly has. To your point, governance, I think, has always been a must-have. And when we're talking about quality investing, quality stocks and that sort of stuff, governance is a given. So I'm not sure why that was ever controversial or why it actually formed part of the conversation. We've avoided things like I don't say Crown Casino or people who you kind of think, well, can I say dodgy? I don't really want to offend anybody who gets sued, but you know what I mean. It's about the smell of something. Sometimes you think, well, okay, I really don't want to get my clients' money in that. And where it's a fund manager, we've had conversations with fund managers to express that view. So governance, has always stood as must have. What else you got? Environmental, yes, very very topical at the moment, and getting a lot of air. I mean, I think one of the ETF providers opened a climate change fund recently, and so it's all very very popular and very very sexy. The social part is a lot more difficult. So when we're looking at a portfolio, one of our overlays is the UN SDGs. So clearly there's some capacity in that to look at the social goals as well. Running our filters through that, we tend to see that's still lagging a little bit in a lot of fund managers, but there are fund managers out there who are further along the ESG spectrum and are looking to have specific impacts in specific areas. So we will kind of blend those into a portfolio, a diversified portfolio, to have that more impactful part of the portfolio, but with that the risk that goes with that as well. So it's almost like in a traditional portfolio having a small caps part of your portfolio. It's going to be more volatile, but you hope it's going to have bigger impacts from a return perspective. So I guess going out on the spectrum with those impact style funds, you're getting some of that alternative beta, if I could use the jargon.
Yeah, that's a really interesting point that you raised, the risks and the analogy of the small caps. You're absolutely right. As a quality, as an investor that looks for quality stocks, there'd be less around because they just haven't had that chance, other chance for the time or the length of time for those, say, small caps to become big caps in this space.
And by definition as well, if something is going out on the spectrum to have an impact, there's a it's not like it's say a mining company or a bank who has been doing the same thing over and over again, just making money, relatively easy. They're really taking some idiosyncratic risk out there with the fact that they will have an impact, change that social condition, and generate a profit from it at the same time.
Yeah, it's there's certainly the profit impact, I guess, the profitability of these companies, which is very important for constructing portfolios, and then there's the social aspect of that, where society might be better off, or and I think do you think clients can sort of take hold of that tangible outcome and to be able to then relate that back to to an interesting part of a conversation where they might relate that to a friend at a barbecue about how their portfolio is doing these good things in the community, not just producing returns for them.
Yeah, I think it's certainly a fringe benefit, if I can put it that way, to have the conversation. Again, I think a lot of our clients, at least initially, don't really fully appreciate that they're having an impact. But once they start to get used to it, and we get some feedback from the fund managers about how it's having an impact, and a couple of funds out there produce some very interesting stuff about where it's having an impact and why it's having an impact. And once we kind of get people into that conversation, yeah, they want more of it. They want to know more, and they take ownership, I guess, is the way to put it.
Yeah, the power of storytelling in this space, that's a really good lesson for a fund manager or anybody constructing portfolios, to tell the good stories out the back of the investment portfolio so people can, share in that story and, as you said, take ownership.
Yeah, I should also relate to you as well. Within our business, it's a bit of a social impact story as well. So, as I said before, Anne runs the business, and until probably about 12 months ago, we were a very undiverse business. We had 11 women and one male, which was me. So, from a social impact, having this female-dominated business gave us a slightly different perspective, and certainly kind of fed into our narrative of what social change looked like at that gender parity level.
Yeah, exactly right, and we're seeing that increasingly with firms now, and more women coming into the profession, and it's been a fantastic thing for the profession to see that. And but you're absolutely right, getting that diversity across genders. There's all sorts of issues in the social spectrum that really don't get a lot of airplay, and I guess the more we can talk about it, the more airplay it gets, the more it becomes part of the norm.
Yeah, absolutely.
David, thanks so much for catching up in this episode. We'll jump into the next one with you very shortly when we start talking about the environmental climate change.
I look forward to it.
Welcome back, Claudia and Michelle.
Okay, here we are.
Hi, Fraser.
Thank you for being part of this episode. We're talking about social change and impact investing, from what I see as sort of a more of a newer approach to ethical investing. A lot of it, ethical investing, started off around climate and those sorts of things. But tell us about what you're seeing in the space for social change.
I think it's amazing that we're actually not just focusing on climate, but it's a more holistic. We're looking at the community. So we're talking from healthcare in terms of technology to property assets, and then we're also looking at home care for health. So these sort of facilities are I think that's one part of the development that I'm seeing. We're definitely talking about how can we relieve the burden on the aging demographic, and that's tackling social. We're talking about how can we make address disability. We're talking about so all the little pieces that fit into those issues. We're seeing that come onto the investment side, where we as we as brothers and sisters can lend a hand and put our money to good use. So, and it addresses all areas of from environment to governance to social.
And sometimes it's like the investment community are replacing some of the role of the government or the responsibility of the government, and then the cost to society or the cost overall is reduced because you're providing better health outcomes, better social outcomes for elderly people or for disadvantaged children. And there's a very long-term benefit, which is not always immediately obvious, but sometimes we can assist the government with their responsibility.
And sometimes it just has to come straight from us, isn't it? I mean, we talk about shareholder advocacy, and that in many ways is doing the job of the government. We're the one who's pushing for companies and product developers. When I say product developers, I'm talking about fund managers to actually push on and do what you know you can.
And it's part of that directing capital to drive change, to drive environmental change or social change, and make things better. And we're in an amazing position where we can facilitate that via our clients' money and the demand and the push that they have, wanting their money to support things that they value.
Yeah, it's amazing, isn't it? Like the advice community knows better than anybody that if you wait for the government to make rule changes, it doesn't always end up, the best way, or it just ends up a way. Decision has to be made, but certainly to be able to drive that social change from the, in the investor point of view, and makes a lot of sense. You mentioned that it sort of doesn't have an immediate impact, but it kind of feels to me like it does have an immediate impact, in local communities and social communities. To me, it almost feels like more so than when you're looking at an environmental product over a long period of time. This area, this impact or social change around communities has a more of an instant impact in your local community.
I think it does take time though, Fraser, I guess from because it's almost, it's a collaborative effort. You need the demand to keep pushing, and sometimes that demand needs to keep pushing for a little while longer before the supply comes onto the market, and then the investors get to support that effort. So it's almost you have this dynamic, but once it happens, and I think it's like fashion. Once you see more and more people wearing purple, it just catches on, and I find that from where I sit, when I find one fund manager launching a certain product and it's done well, and that's when you start to see an influx of a similar theme.
Sorry, Claudia, you lost me at fashion. I'm not sure what you're talking about there. But you're absolutely right about the supply and demand. We all understand that part, right? And you're right. So where are we now, I guess, with consumers at that supply and demand stage? Are we still looking for more consumers to be involved in these before or are the funds now starting to produce really good impact and social change opportunities?
Well, I think that the demand is there in terms of capital. That there's capital out there that wants to support good things, and then so it's a matter of finding the good things that are financially logical and work from an investment point of view. So it's sort of a bit of a juggling act to make sure that we can find an investment that is suitable, sensible, and appropriate for the right clients.
And these investment managers in that space that are doing that, are they working with the businesses individually to make sure that they fit within the sort of parameters around the impact and social change, or are the businesses coming to those funds to sort of to then invest in them, to say, hey, we already do this thing, can you invest in us?
We're quite privileged. We are actually sometimes get invited to participate in the development part of it. So before this is all put together, so the embryonic stage is really fascinating because it allows us to then convey what we're hearing from our clients and let them find options and solutions to put them into a product. So a little bit of both, Fraser.
Yep. I think one of the things I've heard in around Europe is that a lot of superannuation style of funds now are really pushing into this space and saying, that we don't want to have any money in things that are obviously environmentally worse off or socially worse off. How do you see that drive sort of from Europe then translating to what might be happening in Australia?
I think it's very influential. It's definitely it definitely does get a lot of support here, be it Europe or America or even in Asia. I mean, if we hear of any devastating news or initiatives, we tend to it tends to just sit in our head, and then it gels when we find an opportunity that we can link it to.
I think Europe, because of the age of the society and that sort of thing and the size, they might have a bit more capacity and sort of the historic background to support those things, whereas Australia is a very young country, and I think we've got to develop that history, and we're a small country, so sometimes the volume and the capacity is not as available as it is in those larger countries, but we're getting there, I think.
Yeah, fantastic. We're definitely on the journey. Michelle and Claudia, thank you so much for talking to us in this episode. We look forward to catching you in the next one.
Okay, Fraser.
See you.
Joining us again to round out this conversation on impact and social change is Grover Burthey. Burthey, I've got your name wrong.
It's all right. As my wife likes to say, it's like birthday without the D. Birthday.
Birthday, there you go. My apologies. Speaking of impact and social change, tell us a little bit about what you're seeing in that space from where you're sitting.
Sure. Well, certainly first and foremost, when it comes to ESG, it is important to be balanced. And we've spoken, a good bit about topics related to climate and the environment, and I'm sure we'll continue to do so. But there certainly are other areas that are important to the firm, to PIMCO, and to the marketplace with regards to the potential social impact we can have. And we look at a few main topics when it comes to social, in particular. This is not exhaustive, but we focus quite a bit on human capital management, on staffing, on worker treatment, worker rights, and sort of the impact on the broader community from a given business or asset or government. We focus on health and safety and wellness, particularly in areas such as nutrition or food or pharmaceuticals and a variety of other similar topics. Tangible goods. Are those products sourced in a reasonable manner? Are they distributed in a reasonable manner? Are they healthy and constructive for the consumer? And to the extent that claims have been made otherwise, or are they viable, and how are they being reconciled? And we think about, really sort of access. So areas like specialty finance, sort of financial products, mortgage lending. Is there access for the consumer or groups receiving access at comparable or competitive levels where they may not have previously? That doesn't mean, these efforts should grow the pie. It doesn't mean that you have to take an opportunity, right, or a financial tool away from one part of the market and to give it to someone else. But is there equitable processes in place for distribution, and are certain business models looking to bring groups into their model that have had less opportunities in the past? And then there's ultimately ways to measure all this. You can look at it at the specific line item level and encourage more disclosures. It's a theme that we talk about across E&S, more disclosures from counterparties and issuers with regards to their efforts, and doing so ideally on a regular basis with some degree of also projections or foresight in terms of what the future impact will be as well.
Yeah, amazing. Now, tell us a little bit more about that measurement and disclosure, because I think it's a pretty important part when you're measuring that. How do you go about measuring those sorts of things? Because I would imagine it'd be quite difficult and sometimes intangible.
Sure, and there's so many opportunities in the marketplace, right? To some extent, this is why increasing market standards are so important for investors. But and this is one reason why we very much like ESG labeled bonds. Green bonds receive a lot of attention, but this year there's actually been more growth in other types of ESG labeled bonds than green bonds. And what I mean by that, social bonds, sustainability bonds, and then sustainability linked bonds. And with all these different structures out there, you can sometimes get a little tongue tied. But what these structures generally do is not only are they valuable in their own right in terms of the issuers telling you where the proceeds is going to go and giving you information on that, but generally speaking, they're supportive of more disclosure and information in the marketplace. Not only do you receive a framework, ideally up front when a bond is issued, and we at PIMCO review those frameworks in real time and ensure that they're coherent, ensure they're comprehensive and transparent. But then the issuers are then going to update you on their progress, and they're going to provide information about proceeds that were not allocated up front, or about ultimately some of the outcomes of that capital allocation over time. And so as more issuers continue to adopt these structures, then it will provide then a track record of progress and efforts in this regard. And then when it comes to sustainability linked bonds, we actually quite like that structure when done well, when done in a manner that's ambitious, ideally with some real materiality to the business of the respective issuer, whatever that business may be, because it then leads the issuer to put a specific target in place, a milestone in place, make a commitment to reaching that milestone. So from a social standpoint, it could be lending to a certain number of businesses. It could be a certain dollars to a certain community. it can be producing a certain number of jobs, producing a certain number of affordable housing units. There are various KPIs that an issuer can use. But if those targets are not met, then there's a penalty associated with it with regards to the interest expense, to the coupon. And so there's a degree of accountability with regards to hitting those efforts. And so these structures are great, not only because of the fact that it continues to grow the ESG market in general, but because they do encourage more disclosure, more information from these issuers that investors can utilize.
Yeah, fantastic. The exactly right. Just targets, looking at targets, having them publicly, available, disclosed, and then also whether they're hitting them or not. And that's something that I guess the accountability piece that comes in from where you're sitting and in the fund manager space. Talk to us a little bit about the different sectors within, human capital. You mentioned as one of the first ones, rights, health, safety, those sorts of things. How are you are they all categories? Are you like, how are you finding these and monitoring them and looking at them in different ways?
Well, a big part of that is through direct conversations with the issuers or lenders or investors. That's why engagement is such a key piece of all of these efforts. There is more information being provided proactively by companies and market participants, not only with regards to some of the points I made about ESG securities or labeled bonds, but in for example, sustainability reports, increasingly in more mainstream documents, just annual reports or investor reports, investor materials. There's increasing focus on these areas. And for those, this has been largely voluntary thus far, with various regulations coming through different geographies, different regions globally. Much of this will now be increasingly required from a regulation perspective. And so where there hasn't been perhaps as much participation either in certain sectors or in certain regions, as certain regulators move ahead of these trends and want to encourage more sustainability efforts in markets at large, then we certainly expect to see there being more information expectations and reporting expectations placed on issuers. So what does become difficult in this space is trying to do all of this research on your own from a desktop. We believe at PIMCO we can differentiate ourselves in terms of how we weight these efforts, where there is quantitative information being put in place, testing that, making sure that it's honest and transparent and science-based, for example, in the climate space, using that to model a portfolio's overall risk and a portfolio's overall carbon exposure, for example, or measuring the impact from a social standpoint, aggregating that information. There's a lot of analysis that can be done. But the analysis in terms of just the inputs and sort of the sources of information very much encourage the marketplace to continue to provide that and to hopefully do so in a more unified and universal manner.
Absolutely. Now, one of the things that I imagine is very difficult is that supply chain conversation, because it's probably a lot easier to look at stuff that's more localized and be able to walk into a business and see how it's operating and seeing how it's treating its staff. But tell us about how you go through that supply chain piece and then look deeper into where the down the track how things are or sort of before products made it to that factory or whatever it might be. How do you do that?
Yeah, well, we do that first and foremost. Areas like this where it does require scale to really get the information. We certainly rely on and use various collaborative engagement groups in the marketplace. So, for example, right, we're participants in groups such as Climate Action 100. We're participants in a variety of efforts that have to do with food, nutrition, supply chains, such as the Access to Nutrition Initiative. And they're really targeting a certain specified number of issuers that are significant in their space, right? That can serve as role models and leaders, and using those initiatives to really get to scale and to create hopefully standards that can then be adopted by many others. In an ideal world, and we do this where possible, but it's been certainly difficult over the last 18 months. You're able to do your own diligence on the road as well. It's hard to do it all, but there's really nothing that substitutes, right, doing your own core primary research and diligence. And you have to do a little bit of that as well. And that comes with meeting with companies, but also doing some of these more labor intense research efforts. And that's an area that we've done in the past. And with the economies reopening, look forward to hopefully doing some more of that over the next couple of years as well.
Yep. Now, when advisors are talking to their clients and they're looking for tangible conversations, I mean, things like access to nutrition initiative is great. What sort of conversations can advisors have with their clients around what benefit this is doing in society? Like, I mean, I think when we get to the environmental thing, we might talk about taking these many cars off the roads. It's sort of a tangible thing that consumers or clients can hang their hat on. What can they do in this space when it comes to impact and social governance, social benefits for communities? How can they explain that to clients?
Yeah, well, it obviously differs by sector, and in the social space, right? This is an area where there hasn't been as much, in the climate space. There's been a lot of coalition around absolute carbon emissions, carbon intensity. But that's because we're striving for sort of one broad target, which is a lower carbon world. In social, the market hasn't adopted one standalone topic where it says, hey, we're all going to work around and unify this specific topic from a social perspective. So it will vary depending on the asset manager and the strategy. But things that we do look at very regularly, very frequently, and I noted health and safety earlier, sort of accident incidents reports, right? You're talking about labor intense areas. Okay. If there's construction or there's manufacturing, anything that's very labor heavy, this also applies in certain areas of the energy space. Let us know how your workers fare on the sites, on the rigs, in the facilities. This was particularly relevant during COVID, where in these areas, there were tremendous disruptions to businesses based on outbreaks. So give us accident reports, give us information about what happens in the field. When it comes to banks, financial institutions, give us disclosures about the breakdown of those who borrow from you. Is it going to small and medium sized businesses? Is it going to minority communities? Are you going to female entrepreneurs? Give us specific information about your own client base. Try to make commitments with regards to growing that representation of those groups in your overall lending book. Give us some information on what it's been in the past and what you could do in the future. And also to the extent that you can encourage specific outcomes with regards to any KPIs that are sector specific, then you can engage on those in a very direct manner. If you're dealing with the housing space, let us know. Is there going to be a certain amount of affordable units within a multifamily building? If you're building single family homes, right? Give us some information about the impact you're having on the respective communities. There's certainly topics with regards to providing jobs. Jobs is another one. If you're going into an emerging market, are you hiring the local populations, or are you bringing staff from other areas, right? Are you producing sort of economic benefits for the locals, for the population that's immediately impacted by your presence? And so it is an area where you can certainly have that impact and you can measure it, but you do need to be somewhat intentional about the question you're asking, depending on the sector.
Yep. Grover, thank you so much for chatting to us about that. It's great to hear, the influence that you're having on those businesses and those funds that you're those larger companies and companies that you're lending to. So appreciate it. We look forward to catching you in the next episode when we start talking about climate change.
Look forward to the next session.